Bitcoin didn't crash because of bad news. There was no hack, no exchange collapse, no sudden regulation, no headline that justified the speed and violence of the move. And that's exactly why so many people were shocked. Because most investors are still trained to believe that prices move because of news. But that's not how modern markets work anymore. Last week, Bitcoin dropped so fast that even Goldman Sachs described it as a statistically extreme event, something that almost never happens. And yet, it did. Not because Bitcoin failed, but because Bitcoin has quietly changed its role inside the financial system. If you felt confused, frustrated, or blindsided by that move, it's not because you're bad at investing. It's because you're looking at Bitcoin through an old lens that no longer applies. For most of its history, Bitcoin lived in its own world. Crypto exchanges, retail traders, miners, long-term holders. Price moved on narratives, halving cycles, on-chain data, and sentiment. But that Bitcoin doesn't exist anymore. The moment ETFs entered the picture, Bitcoin stopped being just a crypto asset and became a risk component inside institutional portfolios. Today, Bitcoin sits on the same balance sheets as software stocks, growth equities, and other high beta assets. That one change explains almost everything that happened. Here's the uncomfortable truth. Bitcoin didn't fall because something was wrong with Bitcoin. It fell because everything around it was under pressure at the same time. When markets get unstable, risk managers don't analyze narratives. They don't care about long-term adoption or fundamentals. They issue one instruction: reduce exposure, sell risk. And when that order goes out, it applies to everything in the book: tech stocks, leveraged positions, and now Bitcoin ETFs. Bitcoin was sold not because it deserved to be sold, but because it was sitting in the same portfolio as assets that were already bleeding. That explains why the selling started, but it doesn't explain why it accelerated so violently. This is where most people lose the plot. They start looking for a villain, a fund in Asia, a carry trade gone wrong, a single whale. But markets don't usually move because of one actor. They move because of positioning, and positioning is where this story gets interesting. A large amount of institutional Bitcoin exposure isn't directional. Funds aren't always betting on price going up or down. Many are running neutral strategies, like buying Bitcoin through ETFs while shorting futures to capture a spread. On paper, that looks safe. No price risk, just steady returns. But when volatility spikes and risk managers demand positions be closed, even those safe trades have to unwind. That means selling the ETF and buying back futures at the same time. When many large players are forced to do that together, liquidity disappears and price drops faster than most people expect.
Now, layer options on top of that. For weeks, volatility had been low. Dealers sold options cheaply, assuming calm markets would continue. But when price started falling, their hedging models forced them to sell more as price moved lower. Not because they were bearish, but because the math required it. Selling caused more selling caused more hedging, and suddenly the market wasn't reacting to fear, it was reacting to mechanics. This is why the move felt unnatural, because it was. It wasn't driven by emotion, it was driven by systems doing exactly what they're designed to do under stress. And this also explains the most confusing part of the entire event. On one of the worst down days in Bitcoin's history, ETFs showed net inflows. People looked at that and said, smart money is buying the dip. But that's not really what happened. What actually happened was market plumbing. During extreme volatility, market makers sometimes have to sell ETF shares they don't physically have yet in order to hedge risk in real time. That temporarily creates new ETF units. After the chaos settles, real buyers come in and absorb those shares. So those inflows weren't optimism, they were the system breaking and then repairing itself. Bitcoin wasn't being rescued, it was being processed. And here's where the narrative flips. Most people hear this story and think it's bearish. They think Bitcoin has become fragile, controlled by Wall Street, vulnerable to forces it can't escape. But that's the wrong conclusion, because everything you just heard works in both directions. The same ETF structure, the same options hedging, the same feedback loops that amplify the crash will also amplify upside. In fact, they already are. Exchanges like Nasdaq are expanding options capacity on Bitcoin ETFs, which increases leverage and reflexivity. That doesn't make Bitcoin calmer, it makes it more explosive. Bitcoin didn't lose its edge, it gained one. It's now plugged into the deepest liquidity pools in the world. That means when positioning shifts, when exposure flips, when demand overwhelms hedging models, price won't grind higher slowly. It will jump, just like it fell. And it will happen without warning, without headlines, and without giving most people time to react. This is why traditional indicators failed. They weren't wrong, they were outdated. They were built for a market structure that no longer exists. Bitcoin no longer trades only on belief, it trades on balance sheets, margin rules, and institutional risk frameworks, and paradoxically, that's what strengthens it long-term. Because the same system that can force a sell-off can also force a squeeze, and squeezes don't ask permission. So the real lesson from this crash isn't fear, it's clarity. Bitcoin didn't break, the market revealed how it truly works now. And once you understand that, you stop asking why price moved yesterday and start asking where positioning is fragile tomorrow. Because in this version of Bitcoin, the biggest moves won't come from news, they'll come from mechanics, and by the time the headlines catch up, the move will already be over.